5 stock winners from 2018. That's what I'm looking at today. My name's Jeff Beers. This is 40 Finance. Let's dig right in. All right, guys. So the first stock winner on my list is AMD, which is Advanced Micro Devices. I thought this one was pretty interesting because you heard that there's been a pretty big crash in the microchips division, and yet if you got in early on AMD in 2018, you fared just fine, even with all the changes in things like Bitcoin, gaming graphics, etc. We take a look at the start of 2018, and it came in just under $15. It's since up to $18.16 with a pretty big ride in there up to as high of almost $35. The performance year to date is actually 76.65%. So with AMD, you see the price growth here. Obviously, it's taken a hit in the recent stock market downturn, but it started somewhere in the neighborhood of $10. It's hard to tell on this scale of graph, but officially for the year-to-date performance, it's up 76%, currently trading at the time of this of $18.16. And I think the win here is that there's plenty of pockets, even when chips go down, like they have recently, there's still pockets of performance where you could have won for the year. Certainly if you got into AMD a long time ago in 2017 or so, you're doing very well. And that's a stock to keep on your radar for this year as well. Next on our list is Advanced Auto Parts. And you see with Advanced Auto Parts, it's kind of had a roller coaster ride over the past several years. However, in 2018, it looks like it started somewhere in the neighborhood of $100 and it's now trading at $154.13. Its total year-to-date performance is 56%, plus 56%. So I think auto parts are very interesting because it's a place where online e-commerce has not succeeded very well because of the fact that people need parts fast. You know, if your radiator's out, if your brake light's out, you're not going to wait 3 to 5 days to receive the next one. So I think auto parts is one where retail will continue to be very strong. It's just if Advanced Auto Parts can remain competitive. They're currently one of the top players in that space. I think O'Reilly Auto Parts is near behind them. So take a look at this stock. I think it would probably be a cyclical one, but it'd also be pretty safe from some recession fears, particularly since a lot of people will put off buying new cars and invest in fixing their existing cars during a time of uncertainty like we're seeing now. All right, another interesting one on our list here, and that is Chipotle, CMG. And I think I picked Chipotle out of a crowd because I feel like it's been nothing but negativity over the past 18 months for a company that just can't seem to get past the health scares that happen in their restaurants. However, despite all the negative press, in 2018, Chipotle started just under $300. They're now at about $412, and so that's a gain of 47.75%. So if you bought the dip in the middle of the health crisis, so to speak, at the end of 2017, and you've seen some volatility with the stock market and some recent dips, you're still doing pretty well here. And I think at the end of the day, the health scare, the publicity nightmare that Chipotle went through, it definitely hurt them. But over the long haul, I still think Chipotle is a brand that people trust and a brand that people recognize. I go there quite a bit. Their online pickup system, where you order online and pick up in store, has gotten significantly better over the years. And I'm kind of bullish on where this stock can go. It'll take some time to get the full trust of America, but at the end of the day, when I'm in Chipotle's across the Cincinnati area, I always run into a line, so they got to be doing something right. Keep it on your radar. It might be worth checking out in 2019. Next up is another stock that just seems to get bad publicity all the time, not necessarily from under-delivering, but from a stock price scenario. So we have Netflix. I think most of us know that Netflix was highly speculative. In 2018, the price kept going up and up and up beyond valuations anyone could even really have guessed going into the year. But now we've had the stock market sell-off, and yet even with the sell-off and people saying that Netflix and Amazon and all these stocks are too expensive, right? They're not worth investing in. They're going to bust. Disney's coming online. All these things are happening. Can Netflix survive? Well, if you invested in one share at the beginning of 2018, you would have got it for approximately $200. And now through all the roller coasters of the year, it would have been up to a high, a little bit past 400, and you would have landed at 265. So if you never looked at the news from January 1st to the end of the year, you would have ended up at a 38.97% increase. A 38% increase on the year is really good, regardless of what you think of the valuation. It survived announcements from Disney. It survived some of the press of other channels doing the OTT service, HBO, Showtime, etc. Everyone's trying to dig into Netflix. I'm not saying it's the safest stock in the world, but I'm saying it survived a lot of scares. The spotlight's not on it right now. It may be worth looking into as prices have come down significantly with the recent stock market dips. Okay, last on the list is another interesting one. Twitter, who is sort of the redhead stepchild of the social media giants. Twitter had a lot of positive news this year. They went profitable for the first time. They did a lot of work on cleaning up their service. They put a lot of warnings out there that their user numbers were going to dip because they were cleaning out the system. And yet through it all, and with the recent stock market nosedives, Twitter made 37% on the year. And it's not an expensive stock. If you got in at $20 at the beginning of 2018, you're finishing around $30 this year. Some argue it's overpriced. I look at it and say it's worth watching. They're getting less about growth. That's less and less what their conference calls are about, and it's more about profitability. So if you're looking for the next big growth stock, Twitter probably isn't it. However, if they reach a certain amount of profitability, it makes them an intriguing candidate to roll into some other places. You know, eventually Facebook's going to need growth. Google's going to need growth. I don't know if Twitter would ever sell, but with prices like these and profitability on the rise, it's definitely one that you want to look at, particularly like from an ETF standpoint. You know, making sure that you have some exposure to Twitter in an ETF or two makes a lot of sense because they've survived a crazy year with really no big growth earnings news, right? Well, actually earnings, yes, but the growth of users, you know, typically everybody's saying how many users, how fast you're growing. In Twitter's case, they went backwards in users, they went up in profitability. That's a very interesting business case and one worth monitoring. So there you have it, guys. 2018, 5 stock winners from the year. I tried to pick some that have had different news clips throughout the year that might insinuate that they're bad buys, but when you really look at the year-to-date performance, they're actually pretty good. So hopefully this has been educational for you. Please subscribe, share the videos with your friends. My name's Jeff Beers. This is the 40 Finance channel. See you on the next video.